Welcome to the Propertybuyer Podcast, where we explore the world of residential and commercial real estate to help you make better decisions about buying, selling, or investing in all types of property. Join me, Rich Harvey, CEO of Propertybuyer.com.au and multi-award-winning buyer's advocate. Our podcast features expert interviews, market trends and insights, and practical tips for navigating the complex world of Australian real estate. Whether you're a home buyer, a seasoned property investor, commercial buyer, developer, or simply curious about the property market, our podcast is for you. Join us as we share our knowledge, strategies, and experience and help you achieve your property goals. Well, welcome to another edition of the Propertybuyer Podcast. Today we'll be discussing an issue that's close to many people's hearts, and that is money matters, and in particular how we think about money and how we can make better financial decisions, particularly as this relates to property. Being aware of our attitudes and our upbringing around money has a big impact on our future financial behaviour. And in the context of buying a home or investment property, managing, saving and investing money is a critical step to achieve your own personal property goals. Today, I'm delighted to have Evan Lucas join us. He's a seasoned financial expert who's got a passion for markets, which started at a young age, sitting along his grandfather and discussing investments. Evan's journey has been shaped by his deep interest in behavioural finance, a field that he's explored while working overseas in the Netherlands, in the UK and Australia the last 15 years. He's come to understand that our attitudes toward money are uniquely personal and always evolving. He's recently written a book called Mind Over Money. Evan, great to have you in the studio.
Hello, Rich. How are you?
Really well. Fantastic to have you today. And I heard you speak the other day, and I was very excited to connect with you. And looking forward to your insights. But we start our podcast, Evan, just with a little quote or a thought of the week. And I want to throw this at you and just get your take on it. And the quote is from Ralph Waldo Emerson, who says, "The only person you are destined to become is the person you decide to be." What do you take from that?
Yeah, and I think it's a beautiful quote because, again, my learnings, my philosophy when I do what I do is you are self-determined and self-described. So one of the big things that I'm really about and what most of the behavioural psychology, not necessarily just on the behavioural economics, but behavioural psychology talk about is the number one response they get in all of their surveys around bettering oneself, etc., is autonomy. The ability to have the ability to do what you want, when you want, how you want. You know, the ability to self-determine, whatever definition you want to put into it. And that, Emerson quote perfectly defines that, is that if you want autonomy, that means you have decided what to do with your own personal choice and thought process. And so I love that quote because it's exactly sort of something that I try and hit quite heavily when I do what I do.
It's like when you meet someone and you think, oh, do you reckon you can get up this hill? And you meet someone and say, yeah, I'll smash it. And other people go, oh, I'm really not sure. I'm not in shape. And you sort of know who's actually going to make it just by their outlook on life, right?
Yeah, absolutely. And so, again, you don't have to look at money and finance in just the very, very structured views that it can be. As soon as you start bringing in holistic things, and I want to point this out there, I am not that kind of person. Like if you were to talk to me even as little as 5 years ago, thinking about that kind of holistic view, I slightly probably even turn my nose up at you. And I need to be open about that in terms of but it is part of it. I mean, you listen to those that talk about habit. You listen to those that, promote lifestyle. All money is, in my view anyway, is an ability, and I talk about this in the book as well, it's potential, right? Because money basically is an asset you've gained from work or from investing that then has the ability to be turned into, has the potential to be another asset, whether that's an investment property, whether that's other forms of investment, whether it's experience. I think that needs to be pointed out as well, Rich.
Yep.
All of that feels into it because having money physically is fine, but it doesn't actually technically do anything. It's an asset to some extent.
It's a pathway to something else. Look, this is great discussion, but I want to just take one step back, Evan. I just want to ask you, you've worked in a lot of different financial markets, and why do you think that most people fail to actually achieve what I call true financial freedom? What are the major mistakes that they make in their decision making so they don't actually get to financial freedom?
Yeah, so first thing, but we'll go back before we talk about the decisions, is they don't actually know what it is, right? So I think you need to, again, getting back to, and let's use, the Emerson quote, which is the person you decide to be, that second part, the financial decisions you decide, what are they? What is financial freedom to everybody else is going to be different to what.
Exactly. So everyone defines it differently. I mean, some people go, it's $1 million. Other people go, it's 10 weeks off a year. Other people go, to give money to my kids, right? So everyone's got a different definition. But a lot of people often later in life go, you know what, I wish I'd done X, or I wish I hadn't done that. But why do you think most people just don't get to that end point?
And so first and foremost, defining what financial freedom is to you. The other, the reason they don't get there is that most people are reactionary rather than sort of proactive in what they do. That's okay. The other thing that human beings are really good at, and this gets back to, behavioural psychology, one of my absolute sort of idols, and he passed away this year, was Daniel Kahneman, and he invented one of the key pillars of behavioural finance and behavioural economics, which is loss aversion. And you already highlighted it straight out, which is people will always dwell on their bad decisions, but not on the good decisions they made. So he talks about the fact that people will dwell on the small loss rather than the overall position. And again, what is financial freedom to you? The major mistakes people make is that, okay, they don't have the plan. They dwell on their small mistakes, which then make them into major mistakes because you keep doing it. Your inability to look at your financial decisions as a whole rather than an individual, all of those filter into that point. Because, again, as you can hear, I'm sort of not answering the question. And the reason for it is because of you out there listening, your individual decisions will be individual to you, and I don't know what they are. You do. And so the other hard part about what we do, Rich and I, and listening to this is one of the other things to understand is what we're talking about here is what we call sunk cost fallacy, which is, do you keep making the same mistake over and over? Do you keep putting funds, emotion, time, etc., into the mistakes that are leading to more mistakes? And so governments do this all the time, right? So this isn't an individual thing.
That's right. A collective thing, isn't it? Yeah.
So and so don't beat yourself up about your bad decisions. You can change them. You have time on your side. If you know you've got a mistake, you've got the ability to change it. And so all of that's part of the answer is that, again, I'm going to say this directly, and it might sound a bit grating, and I apologise, but we can lead you to water, but you can't drink if you're the horse. So if you can already identify your mistakes, you're already part of the way there. It's then about changing that habit with better decision making going forward.
I think a lot of people fail to achieve financial freedom because they just don't have a plan, or they're procrastinators, or, as you say, they've got incredible fear. I mean, I'm more of an entrepreneur, and my wife is more, the loss aversion type person. And she's very much more conservative, and we're a great balance for each other. She'll look at worst case scenario. I'll look at the facts and go, what is the potential, and what do we need to do to get there? And I think
also see that you love to plow in and she wants to stand still.
Yeah, exactly. And this is where a lot of people just don't end up doing anything for fear of making a mistake. And I've got to say that, the worst thing you can do is do nothing. You can learn so much more from you actually learn more from your mistakes, And Evan, it's funny you mentioned that the people, they value their losses more than value their gains. I'm an economist in my past life as well. I think that's why we connected. But it's funny that people really look so harshly at their mistakes, but don't look at all the great things they've achieved in their life or could achieve in their lives.
So getting back to your question about financial freedom, one of the things that I think that particularly in individualistic nuclear family sort of societies like Australia is you look and think in things in individualistic ways. So you look at your job in one way, you look at your family in one way. And what I mean by one way is that you silo them out, you put them into areas, you put them into pigeons. You don't look at the collective, you don't look at the whole, which collective societies do incredibly well because they tend to pool their funds, they pool their families, they pool their overall thing. So everybody's pulling together, which therefore also minimizes that feeling of loss. So if the family was to lose a reasonable amount of money, let's give an example of like 20 grand, the individual or the individualistic family would feel 20 grand significantly more than the collective, because the collective is going to have more money as a whole. They're much more assertive with their decision-making collective society. Individual, think about it from the point of view also of the overall collective of your whole financial position. What's in your bank account is one thing. What's coming in from income is one thing. Your superannuation balance, another thing. Your investment property, current equity position, another. Your own personal property, another. If you actually write all of those down and looked at the total value together, the holistic view, I promise you your perception will be completely different. And again, if we want to use quotes, the one that I love using at the moment is Michael J. Fox. He talked gratitude. With gratitude, optimism is sustainable. What he's basically saying is that with abundance can get bigger. Yeah. And if you can turn your views, look at things in a different light and actually look at the greater rather than the small, your mistakes disappear a lot easier. Your ability to accept loss gets a lot easier because 20 grand collectively is a reasonable money, but something you can handle. But 20 grand individualistically will seem like a huge amount of money.
Yeah. Now, you're a behavioural economist and you're watching people's patterns of behaviour, but what do you think are some of the key patterns or good behaviours that people use to make good financial decisions? What are the good things that people do?
Good thing is developing automated habit. So what I mean, again, by that idea is that if you look at investment properties are great examples because they also force you into automatic habit. You have to set up structures, you've got income coming in, you've got repayments of loans, you've got all sorts of things, and it develops immediately habits around how you deal with your funds. Across that whole, let's also call it, an investment property is also a small business. I mean, you're basically, you've got an asset, which the business is the house. You've got a tenant, which is your customer. And, the ins and outs that come with that are there. You then also have, the equity that builds up in the business as you pay down the loan, etc. So those habits, those, things that you have to do weekly or monthly to maintain that property, they're the ones that get better at it. Not only that, they also then start to view their money differently. So if I can do it with this investment property, I can probably do it with another one as well. I can use the equity in this and go for another one and so on and so forth. It's not just that, it's then going, okay, the free cash flow that's spinning out of this, I need to diversify. I mean, if you look at modern portfolio theory invented by a guy named Harry Markowitz, which is another guy that, if you do want to look at things, he invented the original idea of the bucket strategy and all this kind of stuff. That's not really the point. He also talks about risk reward, and you will start to actually understand, like what Rich said about how his personality is, that you can start pushing money to other things. So you can maybe start putting $200, $300, $400, $500, $1,000, doesn't matter, whatever it is, to the next part of your overall wealth. That may be investing into, equities. It may be putting money into bonds. It may be adding funds to diversify your overall wealth position and therefore your portfolio. Once you can develop saving and investment habits, it will become a self-fulfilling prophecy. You heard me say this at the event where we met with each other, but I make a bit of a behavioural economist joke about Sir Isaac Newton, which is that I actually think Sir Isaac Newton was a behavioural economist rather than a physicist.
The law of momentum and all that.
Yeah, and the law of momentum. So money at rest stays at rest. Money in motion stays in motion. So once you actually get your money in motion, it's a self-perpetuating thing, and that's the beauty of it. So in answering your question, those that are good with money, they just give their money the nudge to put it into motion.
And it's unemotional too. But you touched on portfolio theory. I just want to touch briefly on that and ask you what your view on how important the role of property is in achieving financial goals. It's not the only way to create wealth, but where do you think the property factor fits into setting?
It's a big start. I mean, it would probably, no other investment overall is going to have such a large increase or decrease. I need to point that out very clearly because we need to be completely even-handed here in your overall wealth, because it's probably, for most people, the only investment vehicle that you're going to have in gearing. Now, what I mean by gearing, I deliberately use the technical term, you're having a mortgage, right? So that debt facility you are actually technically leveraging. because it's also, you can't buy a house outright without it. Most people can't. Some may be able to, but the majority of you can't. You need to start somewhere, and away it goes, which means because you've got gearing, the increase in the price of your property may go up 7% per annum, but once you put the gearing onto it, it will make it significantly better for you. So it is absolutely part and parcel with, you know, really taking that next step up. But Rich already sort of highlighted it before, is that for a lot of people, particularly like, you know, my wife or Rich's wife, that initial step's really hard, because all of a sudden you are going from a mindset and a scenario where you don't have debt to having debt. And some people really don't like that.
Getting used to it, as you say. I know.
Yeah.
Just on your point, you made a really good point, you know, because my first house I bought cost me $245,000. You know, I was like, and I remember my hand shaking as I'm signing the mortgage document and said to my parents, am I doing the right thing? You know, I had no idea what I'm doing. And, you know, that I sold that property, but fast forward, that property would be worth $1.8 million today, you know. And it's just about,
and I'm going to jump in here. That opportunity cost for you out there listening to what Rich just said, do not dwell on opportunity cost, because that's exactly what that will sound like. And again, that is a decision that you can dwell on. It's not one to worry about, because I know Rich will have done something with the money he did make out of that $245,000 property into other things.
Yeah, well, it got us into our you know, we ended up subdividing that property, and that really set us on building a multi-million-dollar.
There you go.
But your point about leverage or gearing, that is so critical. You know, once I understood for myself, you know, 30 years ago, how property investment worked, and it's not rocket science. For me, it's about the little amount of money I can put in and the massive leverage I can get, but leveraging safely, Evan. That's the thing I'm pointing out to the listeners here, because there were lots of spruikers and other people around at the time saying leverage yourself to the absolute hilt. You can if you know what you're doing. And I did it quite successfully, but you've got to be very careful not to bite off more than you can chew. But the power of leverage is the best thing ever, if you can do it well, you know?
Yeah, my argument on that in terms of, if you look at building a house, your builder will be using power tools. Your builder knows how to use those power tools correctly and will build your house really fast. If, however, he or she didn't know how to use it, they could cut their fingers off or, you know, nail their hands to a piece of wood. Leverage and using debt is the similar thing. It's a very powerful tool if you use it correctly. And again, that needs to be pointed out from the point of view that I actually think, you know, without leverage, you basically, you can't get ahead, and that's fine. I think that's the other mental thing that comes in the behaviour side, is that some people have not just an aversion to leverage, but also have this underlying mistrust of it. It's not that. It's a tool. As soon as you have an emotion, belief around things like leverage, that it's awful, it's bad, you know, it puts people into poverty, blah, 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 you've already put in the barrier that won't allow you to get ahead with it. It's a tool. It is not anything more than that.
Really cool. Do you think there's any specific cognitive bias that you see in people that affects property buying?
So perfectly, there's so many different things. So first and foremost, familiarity bias is the first one that I sort of just highlighted there, right? So familiarity is the stuff that you already know. So the learned behaviours that you've had over decades, but it also is the impact of the people, family around you, will provide familiarity bias. So the one that's always a really good example, again, outside of property, because the fastest way to explain it is people tend to invest in what they know. Familiarity, right? So they'll invest in their own business, even if the business is not something you should invest in. Or they'll invest in their family because they know the family, et cetera, et cetera. Property is exactly the same. One of the biggest mistakes you and I will probably see in property is that people will invest in the familiarity, therefore they'll invest in the suburb they possibly grew up in, even though it might not be the property area they need to A, start in, or B, invest in. So familiarity bias, that's a straight out cognitive bias straight off. Another one, availability bias. The information that they get is about a speck of the whole sphere of what they should be doing, because it's easy. I've got this amount of available information. Cool, got enough. I'm done. And again, jumping into property areas or into property investment without the full picture. Confirmation bias is another one. I think this is the idea, and deliberately going and hunting the information that confirms your already thought theory. And the reason they are so common is that you forget human beings are designed and geared, again, there's that word again, to making things easy for ourselves. We try to basically navigate the day as simply as possible. Having to do and make choice, we think we want it, but choice is actually a stop. You have to stop, think. And that actually
takes work,
Yeah, correct. And physiologically, we don't want to do that. We just want to,
really?
Yeah. So biases, the reason they're there is because it's actually a natural, instinctive thing, or as some people would argue, a cognitive thing, so that we can navigate the day. The catch is that they also create, realistically, a bias, all it is a shortcut, right? Yeah. And shortcutting leads to mistakes.
Look, in buying a home, there's a lot of emotions that come up. What's your advice to people about just balancing the emotional appeal of a home versus the financial reality of making that purchase?
So first and foremost, understand you will never, ever completely overcome your own emotion, okay? Because home is that word already invokes emotion. My home, my life, my family is all attached in that word. So emotion is always there. So don't fight it, use it, is always my term. And what I mean by that is that you hear the term don't get attached to the house that you're looking at, getting, absolutely, to start with that. But the emotion also, you can use it positively if you turn around and go, I can see what this house will mean, but it'll also bring about these other issues as well. And if you can therefore use the emotion both positively and negatively, weigh up the pros and cons, you can actually bring your emotion back into line, and the decision making can get clearer. Will my family have the best opportunities for growth in this area? Yes or no? Does my family need this kind of house? Well, actually, it probably doesn't. Okay, all those things you can start to bring emotion in. Again, it's not perfect because emotion is decision making that is done outside of, again, I hate using this term, but it's true, pure economic rational thought. But it has, legitimate response because, again, are the schools nearby that I need them to be nearby for what I want my kids to do? Is the lifestyle that's going to bring me worth paying that little bit more because I'm near to the high street I want to be near to? They are emotional calls that, are part of the value that you're going to attach to that home. So as long as you can see why your emotions are making you feel that way, and if the value that you therefore perceive it is fine, then it is probably the answer. Again, I spoke about this when we said it at the start. This falls under what we call sunk cost fallacy. If you're sinking time, emotion, and energy into something that is negative, then that's cost you'll never get back. But if you're sinking time, energy, and cost into something that's giving you benefit, even though it might actually be costly for you, there is an argument that it's actually worth it. And so I would never say you can regulate, your emotion with property because property has such a visceral response. As long as you can justify your emotion with a fairly cognitive understanding, not necessarily just financial, that can actually sometimes be your answer.
I'll give you one example of what you're talking about. During COVID, the property market went nuts, right? And we had this fear of missing out. FOMO was everywhere, and we represent a lot of people at auctions, and just basically remove the emotional aspect for nervous bidders, particularly. But the problem is we're up against other nervous bidders, and we came up with a term for these other types of crazy bidders in our office, and we call them wounded bulls. So they're people who kept missing out at auction, auction up literally 5 or 6 auctions. They turn up to the next auction. The house may or may not be quite right for them, but they're going to buy it regardless because they're sick of looking. They want their weekends back. They've got their horns up and they're just charging full pelt to get their property. And no matter what your limit is, they're just going to exceed your limit. So with those sort of auctions, we just never were successful at them because we're competing against people that are just emotionally charged. We really appreciate you tuning in to the Property Buyer Podcast, and I hope that you're finding our expert interviews helpful. So that we can keep providing this information and growing our audience, we rely on word-of-mouth recommendations. If you found this information useful, could I please ask you to share this podcast with your friends, family and colleagues, and ask them to subscribe to the Property Buyer Podcast. It would be a big help, and we'd be very grateful for your support. Thanks once again for sharing the links, And now, let's get back to the podcast.
Yeah, and they've therefore lost perspective. You know, the value, the sunk cost in that is different. So their emotion is overriding all other value. So they are sinking too much time and effort, and therefore because of that, they are making bad decisions. And that's part of it. There's also, again, the one argument that everybody will point out with the COVID scenario is that also we forget during 2012 through about 2019. Nobody really talked about the RBA or things like inflation because they were at such unconventional levels. Inflation was actually below target, and money during that period actually was some of the cheapest it's ever been. Now, obviously, it got to the cheapest during COVID. So our ability to use leverage productively by buying property got instilled in a generation for just over a decade. And then COVID hit, and all of a sudden, that time that they were waiting for that perfect opportunity got messed, and therefore decision-making got thrown out of the wall, and we then had record low interest rates and record low borrow rates. Those two together, in my view, from the behavioural economics side, that's when we get to a real problem because you have economic policy and behavioural irrationalism colliding.
Interesting. I want to talk a bit about investment property and how people make decisions around that. You've travelled a lot internationally and you've seen markets in different countries, but particularly what are the unique traits that you've noticed about Australians and their approach to investing in property?
So Australians have grown up with generations that have seen property as the number one fundamental way to build wealth. If you look at particularly places like Europe, where property is not, 250 years old, it's, upwards of 1,000 years old in some parts, or as in high developed, cities that have been around for almost millennia. They're different. So their ability to own property or to get into new property is very, very low. They're much, much happier to rent. Whereas Australians have always grown up with the ability, or at least the thought process, that they can not just own their own home, but actually grow their wealth through property. And that makes complete sense. And there is no doubt that, if you look at the time that generations of, late X's, baby boomers have had, they have grown their wealth very, very well because of the economic conditions they've been in, which is we've had net migration since Second World War that's, continued to put decent demand and upward pressure on pricing. You've had series of, economic booms, whether even with the recessions we had in the 80s and 90s, the China story has been a massive boon for us, and the expansion of things like mining, the overall import of all of this. The reason I start with all this sort of technical stuff is that has built a culture and a mandate relationship with property that is now ingrained into how we think. So investment properties are absolutely part and parcel with how we see wealth creation. And that is absolutely fundamentally core to how we think compared to overseas, where they don't do it in the same way, and it hasn't had the economic growth expansion that we were lucky to have after things like the Second World War, because they were either recuperating or again they are a developed economy or a legacy economy. Because that also filters into all of that discussion, is that, again, if you've got that net migration, that constant demand, supply in Australia has always been a laggard compared to where we have been in the cycle, you're going to have simple economics, supply and demand, and price continue to increase. So investment properties make complete sense. Again, leverage comes into it as well. And you can start to develop a very large portfolio very quickly. And people have. Now, by quickly, I mean over, 7+ years. So it makes complete sense that it silts and filters into that space. Yeah. So that's the thinking and the economics of it. Again, like any market, there are foibles. Like any market, there are ups and downs. And again, choosing the right suburbs, the right places, that is also part and parcel with that answer. But overall, that's... Yeah.
So for someone, just as a quick piece of advice, what would be sort of most important, or just one tip you'd give to someone who's trying to get into the market for their first investment property?
Yes. It's probably two parts. First and foremost, we already sort of discussed one of it. Your investment property is not your own property. So you do not look at it buying an investment property with the same lens as your owner-occupier house. That I think needs to be your start point. Your second is, again, what we started at the start of this whole discussion. What does financial freedom look like to you, and where does that investment property sit? So that point can also therefore frame the cost of the investment property that you want, the type of investment property. And by that, I mean, do you need to actually think about an apartment over a townhouse, or a townhouse over a house, so on and so forth? Because again, your first property is like starting with anything. You shouldn't be running a marathon or 42 Ks of it straight off the bat. You don't just walk out your front door and run 42 Ks, go in and buy the largest investment property you can. You start with the first couple of Ks to get your body to go. Same principle. So that's what I would say is, take the owner-occupier emotion out of it, because it's not that. You're not going to live in it. It's not for you. It's for your overall wealth. And then look at the baby steps that you are taking to your whole marathon in your process.
I really like that. It's like begin with the end in mind. You got the great Steve quote. But it's like, for me, when I'm buying my next investment property, I ask the question, does this get me closer toward my end goal, or is it going to detract or sidetrack me and get me in a sort of a debt trap? So you've got to ask, what is this property going to do for you in terms of its yield, in terms of its capital growth, and its overall, how much energy and time it's going to suck from you as well. So that's important.
And so let's use that exact point in data. So if you still look in Australia, over 85% of all investors still invest in the city they live in, let alone the state. And so, again, that is also part of what Rich has said there straight out, is that you need to remember that where you live is not necessarily the investment place for your investment property. And those that can and look outside the overall space that they live in tend to do better, because the yield and the growth in the investment property you're getting may not even be in the state you live in.
Exactly.
As soon as you can see that, it gives you, I guarantee it, in fact, it immediately gives you an edge over that next person, because I promise you that next person's not thinking like that. 85% of them tell you that.
Evan, I want to ask you about timing, because I get asked this question. How important is timing when buying the property?
Zero.
Do you think there are any indicators flashing lights saying now's the right time to buy? What's your spin on that?
No. So it's like anything, right? Timing the market rather than timing the market. Yeah. And it doesn't matter which market you want to look at, equities, bonds, cash, property. Because again, a property investment is not for tomorrow. A property investment is for decade from tomorrow.
Yeah.
And so there is no such thing as timing the market. Yes, you can point to, certain markets, as we just discussed, that may be getting expensive. So if we want to give an example, you can look at somewhere like the South Australian Adelaide market, which is probably topping out with the economics that are in it. But that may only be for 18 months. Again, that doesn't matter if your time tomorrow is a decade from tomorrow. Yeah. The timing thing, that rule holds true in any market and any asset. It's not tomorrow, it's in a decade from now, and therefore it shouldn't really matter. It's more about if you've done your research correctly and you have understood the projected 10-year growth plan for that asset, then that's more what matters, rather than the fact that there could be an economic movement in the next 18 months.
Yeah, love that. It's so articulate. I guess this next question is very similar, but many people wait or want to sort of wait for the market to drop. They say
it's the same problem.
Can't wait for the market to crash. What's your take on that approach, if waiting for the market to drop?
So, again, let's use property as a great example here. The amount of people that have told me over the last 15 years that the Australian housing market is primed to fall by half or by 30%, or that the Australian housing market is an absolute Ponzi scheme, and et cetera, et cetera, et cetera. Who cares? Because they're all basically living in that mantra. They think they know that the market's at the top, it's going to crash, and I'm going to get a better price. And they have waited and waited for 15 years. Now, if you look at the growth in the Australian housing market over the last 15 years, a cumulative basis from 15 years ago is about 75% across the whole country. So they have missed 75% of growth, waiting for a 5-10% decline.
Talk about an opportunity cost there.
Yes, bingo. And that's exactly that, right? So that was my next point, is that trying to time the market by saying it's going to crash is an opportunity cost that is also just as bad. There is never a right time. There is never a right time, and therefore there is also technically never a wrong time. Rich's story before about, his hand shaking at 245,000, that sounds incredible. But at the time, I know that he would have been feeling, we're at the top. I'm putting myself in sort of, a bit of financial strain, but the longer term out view is clear. And again, let's use the industry super fun thing, historical averages are not a future guarantee. That's fine. That's true. But again, if you look all the way back to 1910, they're on average, you're looking between 5 and 10% per annum. And as soon as I have in my book, and I talk about this a lot, if you can learn to love what I refer to as the scary ugly, then away you go.
I love that. That's so cool. It's about getting comfortable with the uncomfortable, right?
Yeah. And it's also about understanding that what happens today, month, week, year means nothing, because when we talk about stuff, 7% per annum, that's to smooth that average. Here's an example. Here's a question for you. When's the last time the housing market grew by 7.2%, which is the historical average for the last 30 years?
Yeah. It's been, well, exactly.
I'll be honest with you, never, right? So I've given you a trick question. It's never done it in the last 30 years because it's moved 11%, or it's, done 5%, or it's slightly set flat.
It's never been bang on the average. Yeah.
It's never been bang on the average, but we tell you the average.
That's right.
And again, if you smooth out that 7%, that smooth line looks much, much better than the scary ugly line that is the yearly, daily movements.
Get used to the wave, get used to the ride.
Yeah. The other advantage that property has over, what I originally started in, which is things like bonds and equities, we don't have a big, massive neon sign above our houses. You don't come home from work every day and there's a big neon sign saying, today your house appreciated by $10,000, or today your house fell by $12,000. That's the advantage of property, so that you don't have it priced all the time. You've got a rough idea, but you don't have down to the cent exactly how much your property is worth, which again helps because you don't get caught up in exactly what we're talking about here with the scary ugly of watching your value, day to day jump around a bit, when realistically, over the longer term, if you know what you bought it for 10 years ago to what it's worth today, that's all that matters.
Excellent. I want to talk about negotiations in a second, but I just want to go back one, this leverage bit, because, for me, the advice that I give people about, when should I buy, or, what's the best tip you can get, and I say about timing, I say to people, you buy when you can afford to buy. The minute your income is high enough, you qualify for a bank loan, and you can go to the broker and say, hey, I'd like to buy a property, because the opportunity cost every year that passes you by, when you do your tax return and you've got those figures there and you can apply for a loan and don't do it, that's, $50, $100, $200,000 that goes out the window in capital gains that you could have made. So for me, I love leverage. I love looking at, how I can buy my next property based on what income I'm earning that year. So that's my advice to get into the market. But let's talk about negotiation skills, Evan. Why do most people fail at negotiation skills, particularly when buying a property? Or do you think it's and negotiating?
Yes and no. So again, emotion's the first point. So if your emotion is so caught up on the idea that this is the one, I'm willing to pay whatever, an agent's going to know that off the bat, and they're going to see you coming a mile away. And because of that, your negotiation's already gone out the window. So, the ability to, first and foremost, hold firm. If you've gone into a scenario where, the property gets passed in and you're the top bidder, and you then go into negotiation, in my view, you're already winning, because you're clearly going to get a property at a price that is much more in your advantage than the seller. And so it's realizing the situation, I think, is the first point, because negotiation is just trade-offs and knowing the situation and the hand that you're holding. And why I say hand is, again, like anything, and that's why someone like Rich is, he does this for a living, and the negotiation skills that he has, he doesn't have emotion. He's not attached to the property. His only attachment is to you as the prospective buyer to get you the price that is the best for you, because you can step back and he doesn't have that emotion, immediately the negotiation is clearer. He's much clearer in his thinking. He knows where he can sit, and that's why buyer's advocates are fantastic. But getting back to your point, it's all about understanding where your emotion is at and keeping that under control, but also then using your own personal biases to your advantage. And again, what I mean by the biases here is, are you somebody that's overly assertive or somebody that is, a little bit more conservative and a little bit quieter? If you're somebody quieter, that can actually help you, because one of the things you learn in negotiation tactics is that actually the first person to speak normally ends up actually losing. And the reason for that is that they're trying to break the social norm of the unconventional silence that comes with these kinds of things. So you know your weaks and balances. Know your strengths and balances, and so use that to your advantage. Sometimes not speaking is actually in your advantage, because the agent can blurt out something that you didn't realize existed, or that you just sitting on your hands and holding firm at the price you've given can actually end up leading to a better price overall.
No fear of loss. That's what I have. I love negotiating. It's a game.
I bet you do.
We absolutely do. We have a lot of fun with it. I want to move on to managing risk. What's your advice on how people can manage risk that are looking to enter the property market, particularly in high demand cities around Australia? A lot of people think, property investing is risky. What's your take on that?
So anything is inherently risky. So that's why I start from that point. I mean, getting back to Harry Markowitz and his portfolio theory, the reason I start there is that his whole concept is that it's risk reward. So even putting your money at the bank has a risk, right? It has some inherent risk to it. So it's about understanding that if you can spread your risk across that curve, the further up the risk you go, the better your return is. Absolutely. But the way that you can manage it the best is to actually draw the straight line between the two axes and spread your risk across it. So don't have all of your eggs in one basket. Exists for a reason. It allows you to therefore buy your investment property, but not have it as the only major risk in your portfolio. Having cash to back you up if you needed to, having other asset classes in your overall wealth will manage the risk better, because diversification means, we've just spoken about, the ups and downs of markets and loving the scary ugly, is when your housing market does really well, but your superannuation, which is exposed to more likely equities, does poorly, they net each other out, and vice versa. Or, let's say inflation plummets and cash rates go down, your cash is actually going to really suffer and go backwards because inflation is going to eat into it. But you've got property and equities to offset that. So for me, again, and I've come from my background and from my world, it's about diversification. Property is absolutely part of my diversification in my overall wealth, but it's not the only asset I hold, and nor do all of you listening to this out there. Your superannuation gives you an incredible diversification you probably don't necessarily look at. If you look at it as a whole, it gives you that exposure to not just property, but everything else that you may not think about, and therefore you can concentrate in your own world on property, knowing that you're diversified through your superannuation.
Exactly. I mean, that's how I approach it too, Evan. For me, it's like, I think the other point to make is when you're investing in property, make sure you've got enough buffer. Set up a line of credit, set up an offset account, and just, what often happens is your hot water system goes on 3 properties at once, and then you find there's termites in the garden that need treatment, and suddenly 10 grand goes out the door in a week. Now, if you haven't budgeted for that, that's going to be a problem. So make sure you've got buffers and you manage those risks. The other point about diversification is you can also diversify within your property portfolio, and you must do that, is my recommendation. So, being a borderless investor, as you've talked about, across states to minimise your land tax, but more importantly, to take advantage of different property cycles occurring in different cities. Is another really important factor. I want to ask you again, I don't know what your comments are, but about buying in different property markets. If you're an investor, how should investors assess different areas that have the potential for growth? How do you to another?
So that will put and I know you do this as well, my almost pure economics hat on. So let's use history as an example. So Queensland's a great one. Through 2012 through to even 2022, why I use that is that there were several events that happened during that period that really made Queensland really attractive, like highly attractive. First and foremost, start of 2010-11, there was a lot of investment into gas assets. So you look at the Gladstone market, you look at things like Townsville and Cairns and what was going on up there. The attraction was huge. You then had changes to particularly holiday laws with regards to people coming in. So they had booms. They had this huge growth of jobs, huge attraction for people to move to these areas for that economics. And therefore, the property increases that were happening there were staggering. Again, you can go back even further and look in the 2000s. Port Hedland's the great example. As soon as they make TV programs about it, that you're probably seeing, like the taxi driver comment of, it's peaking out, but you saw 400% increases on homes that were literally falling over. So for me, it's about learning the economics first and foremost. So what's the economic driver? What's the growth that will come from that? Where are the jobs? Where's the money flowing from? Is it, certain sectors that it's overexposed to? So is it mining and therefore it has risks around things like, China slowing down, or does it have exposure to something like tech, for example, and therefore, it's made tech centers around it and the investment that's going to bring, that might be a bit more secure than a cyclical market like a mining company or a mining town. They're my start points. So that's how I look at things, because that's my economics background. And as soon as you know that an area has got a economic attraction, as I call them, then you've got a solid basis. Then your next thing is the research about, okay, which suburbs have already moved and why? What's the suburbs nearest to that are now experiencing that? Is there a new infrastructure hub that's there? So is there a new train station that's being developed around, and therefore the ability for people to move from their place of living to their place of work going to get easier? That's going to be an attraction for people, and therefore the price of those places is also going to be part and parcel with the answer. There's so many things, but that's how I look at things. Is that
I've got about 20 factors on my website. Yeah. But I think just to summarise your point, I often joke that property investing is as easy as pie, P-I-E.
Yeah.
3 factors: population growth, infrastructure development, and diverse employment opportunities. And
well, there we go.
Right, so mate, you bang on. I want to talk about investment strategy and long-term thinking, which you touched on at the beginning, because not many people are able to put the long-term thinking cap on. How important is it to set longer-term financial goals, and how should they shape someone's investment strategy?
Yeah, so first and foremost, putting my behaviour hat back on, this is one of the hardest things to do. Visualising future time is something that we are not geared to do. We are geared towards what's called instant return. I mean, think about it. You want food, you go and eat it. You need to go to sleep, you go to sleep. Human beings over the last several millennia have developed into a scenario where they now live in delayed returns, which is I'm making a decision today for the hope, and that's what it is, that tomorrow it will come off. So I'm putting my lunch together for the hope that tomorrow it's going to be still okay and I'm going to like eating it. Investment decisions are even further. I'm making a decision today for, in a decade's time, for it to come off. And it's very hard. And there is no way I'm going to say that it doesn't feel any easier. Again, we've spoken through this whole, discussion that there are ways to get around it. But first and foremost, it gets back to financial autonomy. Your long-term wealth will give that ability to give you a scenario where you don't have to think about it. You can do what you want, when you want, how you want. Lays the foundations about why. The next thing is automating. I'm buying this investment property today because over the time of what I want to achieve in my financial autonomy life, this is going to help me get there in that period of time. My superannuation is going in from the work that I have, also allowing me to reach the time factor that I have. So you start to allow your mind to accept that time is part and parcel with what you have to do. The next part of that discussion that I sort of have is, again, holistic view. I've got my cash in my balance account for today. So if I had all of those, hot water services blow up, like Rich said before, I've got the money. The money is there, and I can live for 3, 4, 5 months if I lost my job as well. All of the above, that's there. So what you're really saying, it's about the structure of your money over time. Have I got money for today, for tomorrow, and beyond? That's how I always talk about it. And once you start putting time over a continuum, you've got money for today and you're happy to live with it. Therefore, I can put a little bit more money into tomorrow and a little bit more money into the future. And as soon as you start spreading your money over time, it's much easier to deal with the long-term view because it's part of the whole process rather than all of your money feel like it's going out to a period of time that you cannot touch. And that's what it means. So when you talk to people about superannuation, your superannuation money's coming. Even those that are within 5 years of superannuation still feel like it's an absolute eternity away. So it's about spreading, like diversifying your portfolio, diversify your money over time. Your money for today, your money for tomorrow, and your money for beyond.
I love that. That's such a great answer. And property is a big commitment, right? So what are some of the biggest mistakes you've seen people make when they don't have a long-term strategy?
No, first one is over leveraging. So they want to do everything now. So when they don't have that longer-term strategy of going, I need to allow the wealth, the capital gains in this property grow before I then go and do the next one. That's one of the first things. So, you look at those that over leverage, interest rates go up in the short term, like we're seeing right now, and all of a sudden that over leverage becomes a financial burden they can't sustain. So trying to do everything in one shot. Again, the marathon sort of conundrum. Don't run a marathon off the bat. You need to build. And your portfolio in property is not going to happen overnight. In fact, I'd argue it's not going to happen over 5 years. It's going to take you a decade to get to the level that you probably want to be at that point. That's one of the first things.
A lot of people just jumping in there too, Evan. I see a lot of people chopping and changing strategies.
Yeah.
They'll see the new shiny new thing that comes on Instagram and see some post of someone who's made $1 squillion doing XYZ strategy. Jump in, like NDIS or something like that. But, there's a lot of risks with, changing. Also you chew up a lot of tax dollars. You end up paying stamp duty. You end up paying extra taxes. So chopping and changing strategies is something for what I call the impatient investor.
So that's the timing of the market counterpart to it, right? At the same time, it's believing that you can buy and sell at the top, buying at the bottom, selling at the top, in and out, in and out, in and out. All of the administration costs are going to eat that up. The taxation, everything else in between. That's again with anything, trying to time the market, trying to trade the market, whatever terminology you want to use, it's all the same mistake, which is you are not there to do that. You are here to accumulate wealth, not to trade wealth.
Love that, accumulation. I've got a couple questions I want to finish with the last part of our podcast today is just looking ahead, like looking into the distance about the economy, putting your economist hat on. So next year we're expecting to see an interest rate cut or two, or maybe three, who knows. How do you see the interest rate environment changing next year, impacting the property market, and how should people factor that into their decision making?
So first and foremost, it will change. The question is the time. And this year in 2024 threw a lot of my models out because I went back to my behavioural side and said, you are not listening to the gatekeeper. You are not listening to the RBA. The RBA is the gatekeeper. Whether we like it or not, doesn't matter. What are they saying? What are they doing? And how are they acting? And therefore, don't worry about your models or other, people that you might like to listen to and their models, blah, blah, blah. What is the model of the RBA? And the RBA's models at the moment and their forecasts tell us that they don't believe that inflation will get back into target until midway through 2026, not 2025, 2026. They do talk about the fact that they are factoring in the market putting rate cuts into their forecasts and the impact that will have on their inflation views. So they know it's coming. But what they are telling you is that their timing on this is a lot further out than what market economists, the market currently thinks. So I have changed all of my views to follow what the RBA is saying rather than what the models can give you an answer to.
But sometimes they get it wrong. I mean, the thing is, because I often look at those RBA models and go, yeah, look, they're beautifully constructed, But talking to the man on the street, talking to the small business owner, the millions of business owners, the medium businesses, the large businesses, and seeing what's going on, I think sometimes the RBA is a little bit behind the eight ball. And I was reading something the other day that they're starting to do more producer and consumer surveys, which I think will be critical to helping them guide their models, because sometimes they either pull the trigger too early or too late, and they're not reading the signals. So, yeah, it'd be interesting to see.
Yeah, but also this is my assessment of exactly those points, which is, with that in mind, they will cut rates in 2025. They will. That is a given. The reason I said timing is that I feel we're going to go through what the US went through this year. The forecast was for March. They didn't move until September. The forecast is for possibly February. The more realistic thing is May, June. In my view, in fact, it's June, July. Now, let me give you a reasoning for that. If their forecast for the final quarter of this calendar year is true, which for trim mean, the actual, core inflation here in Australia, taking out the top 15 and bottom 15% of the inflation read, they have that at 3.4% in the final quarter. That data is released on the 30th of January next year. The next meeting after that is February, and that is not going to be enough, in my view, to be sustainably back to target in terms of where it is, because if you look at the sticky inflation parts, they're still sitting at 4%. If you look at government intervention, that's sitting at 4.5%, so on and so forth. The issue also now with the changes to the RBA, rather than doing one a month, but now 8 meetings a year, the meeting after February is the 1st of April, and I'm not exaggerating, it is actually April Fool's Day. That is also likely to be when the Prime Minister is walking down the street to Government House and declaring Parliament dissolved. The next one is going to be May, and that's either going to be the Tuesday before or the Tuesday after the federal election that he will have called in April. The meeting after that is mid-June. And going by history, the RBA does not like to get involved with politics. It has. In fact, very recently it did. We did see a RBA change in the month of an election at the last period with Scott Morrison getting in. But historically, they try and stay away from it. And they're going to also have to therefore deal with what elections bring, which is, as we've already saw last week, the possibility of additional fiscal stimulus going into a market that is slowing growth-wise, but in terms of inflation and employment, doing pretty well.
Okay. So what's your perspectives on the property market over the next 10 years? Have you got a crystal ball? What do you think are the opportunities and threats coming in the property market?
Yeah, crystal ball. So first and foremost, the 3 markets that make me a little bit nervous are Brisbane, Adelaide and Perth. And the reason for that, they're at peak. Now, again, as I said, trying to time the market is absolutely out the window. Don't do that. But you would probably, again, particularly to some extent Adelaide, the incomes that Adelaide generates, the house prices that are there, they make me nervous. There has to be a moderation, not necessarily a correction, maybe a pullback, so 5% from the current level. So the growth in that is looking a little bit thin. Brisbane, you'd make the same argument. I mean, Brisbane now has a higher median house price than Melbourne and a population that is almost half the size of it. That also makes me a little bit nervous. Perth is clearly going through a boom, as it always does, with property cycles and commodity cycles, and it has come from a low base. Like, it was lagging the rest of the country, and it's more catching up. Sydney is Sydney. I never talk about Sydney because you can never fully understand it. It is an incredibly robust market no matter what. What's more happening is people are moving out rather than actually selling down their home. They are just leaving the city because they can't afford it rather than anything else. I can't see Sydney house prices tanking, but they are slowing. Melbourne's the interesting one, and I'll put my hand up. I do live in it. Melbourne is interesting from the point of view that it is now the laggard out there. Now, there are good reasons for that, particularly around state regulation. So that is also my catch, is that the Melbourne market will have to sooner or later catch up. The median price is below markets that it shouldn't be. The economics here are okay, not great, but they're okay. And the incomes are higher than some of their other comparable markets. So again, we discussed this before. What do I use as my looks? They're my looks. The housing market, though, in longer term, still see the same thing. We have a supply problem. Demand is still there. Over the next decade, will house prices be higher? Yes.
Yeah. I agree with your assessment of Melbourne. In fact, we're plugging that as the best counter-cyclical capital city investment you can make currently. I still think there's still petrol in the tank for Brisbane, particularly, Adelaide as well. Perth, maybe for a year or two. So I think there's different drivers, and I think before anyone picks a winner, you've got to understand the context of what you're doing and how you're going to go out. Don't just pick just because of one podcast tip.
And again, as I want to point out, I'm not predicting a crash or a pullback or a correction. The growth rate that they've experienced, that's going to moderate. That's the term. I mean, you've got 22% in Perth, 15.5% in Brisbane, and 14.5% in Adelaide over the last year. It's not going to do that again. No, that's not going to do that again. That's what I mean.
Yeah, great. 2 more questions for you before we wrap up. How can the younger generation get on the property ladder? It feels like they're being left behind. What's your advice to help the younger generation?
Okay, so I'm going to put this out. I'm a millennial, so before you get angry at me, I'm a millennial.
Yeah.
The first foremost thing is the behaviour side. Don't expect to buy your parents' house off the bat. So that's the first argument I put towards.
I love that.
Yeah. So if you ask your parents, they would have bought a small property of some description off the bat. They would not have bought the house you currently live in off the bat. So that's the first thing to remember. Second is this. It's taking you longer to get in and you're having to raise more money than you had before. But what I would point out is that first homeowners at the moment are some of the highest rates we've actually seen in a long time. So people are getting in, and the reason they're getting in is that because of the pricing that's going on, they're being forced rather than sort of maybe rational thinking to buy a property they wouldn't necessarily consider initially. So you can absolutely start. There is properties that you can afford. It's probably the question is it the one you wanted? And that is where I start with, don't expect to buy your parents' house off the bat, and nor should you want to, because the upkeep of a 3, 4, 5 bedroom house compared to an upkeep of a 2-bedroom townhouse, etc., is significantly different with regards to, your property taxes, your overall council rates, etc. Stay again with some rationality around the idea of what is this property for? This is my first home. I'm going to live in it, maybe with a renting friend. I'm going to live in it with my partner, maybe. I want to start my property, journey, and therefore it's an investment. If it's an investment, then that immediately changes your view as well. Units, apartments are still part and parcel with your thought process. And that means, it can all of a sudden reduce that massive fear of that initial price point of, I need to have the median house price in Australia, which is $750,000. Well, no, you don't. What you're after is a property that's, in line between $400,000 and $600,000 with a mortgage that you can sustain a bit better, and having that 7.5% growth over the next 5 to 10 years is what you're doing before you then be clinical and say, right, it's done exactly what I needed to do. Now I can sell the thing. Your expectations is basically the answer. What are your expectations and why are you doing the start? The start is the marathon. I'm starting my journey, my marathon journey. I'm not starting the marathon off the bat.
Fantastic. And finally, can you give us maybe your best property tip that you'd love to share with our audience? Property or finance tip, either one. Which one?
Yeah. So I don't have one. And the reason, because there is no silver bullet. That's my answer, right? So I don't have one because if it existed, everyone would do it and everybody would be there. Warren Buffett doesn't have the silver bullet, and he openly tells you that. What he says is there is an array of answers, and it's a combination of those answers that will actually be the best financial tip you can do.
Awesome. Oh, Evan Lucas, it's been a pleasure chatting with you today. You're a font of knowledge. If someone wants to read your book or get more information, where can they get that from? All
good bookstores or online at Amazon. You'll be able to find my second edition that came out at the end of last year.
And it's called Mind Over Money. Is that right?
It is indeed.
Fantastic. Well, look, thank you again, Evan. Been a pleasure having you. Really appreciate it.
Thanks, Rich.
Thank you. Thanks for being with us on another Property Buyer podcast. If you have a question you'd like to ask, please click on the SpeakPipe link and we'll answer this during the next episode. If you're looking to buy a residential or commercial property in the near future and would like to get the added advantage of having a buyer's advocate on your side, then please reach out to my team today and send us your inquiry, and we'd be delighted to help. Please visit our website at propertybuyer.com.au, where you can stay updated with all my latest market updates, weekly blogs and live suburb profiles to help you make better property decisions. We look forward to connecting with you again on the next Property Buyer Podcast.